All right, we're going to jump into this and we're going to talk about HSAs. There's been some changes. I don't know if you know this. There's some changes happening. And if you don't know, I don't know what you're doing. One of the big changes that's important for us to know that is changed, it is now law and isn't going to go away, is that Congress threw out this random statement that said any catastrophic or bronze plan purchased on the marketplace allows you to contribute to an HSA. That's a game changer. That is a huge game changer. So I'm really excited about that. So this previous HSAs were a very different class. So the income cliff is returning for 2026. It is a cliff. If you started selling insurance during COVID, you don't even know what this means. You may have heard about it, but it wasn't real. This happened back in 2018. So this isn't new. It's just new for now. And in some ways, we have more options than we ever had. Because when I had that, there wasn't a lot of options. So let's talk about what I mean when I say HSAs. So I do hate to be the bearer of bad news. I'm telling my clients, I got to tell you what's happening. What's happening is the income cliff is coming back, and your income is more important than it has ever been. Sort your clients out. See who's close to the federal poverty level and contact them. If they're under, they're fine. There really isn't. Don't worry about people who are under the 400% of the federal poverty level. Their rate's going to go up 1.5%, maybe, depends. There's all these, every year rates change. Don't panic about people that are under there. You tell them, oh, you're under the 400, you're fine. Your rate's going to be affordable. They just need to hear you say that. If they need to pay $5 for their insurance, they'll pay $5. People are not going to not take their insurance because it costs them $4 or $7 or $15 because they know they need it. As long as you weren't selling a $0 premium. That's how a lot of that fraud happened. They were too busy talking about the $0 premium. So now you get to educate your clients. You're going to make people your clients for life by educating them. So while I am the bearer of bad news, I also have some good news. So in this session, we're going to talk about understanding the changes that really matter in regards to the cliff, how to understand an HSA, how they could help reduce the client's premium, understanding tax credits to avoid those pitfalls, a little bit of the alternatives, options if the income is too high, and to determine what insurance best fits them. So again, I'm doing this as if you're my client. All right, key changes for 2026. Some of this could change, but this is what is happening for 2026, unless Congress gets their act together. The expiration of enhanced premium tax credits, increased out-of-pocket maximums, potentially, changes in the special enrollment, and as well as other changes that shouldn't affect any of my clients, right? It's going to affect new clients, but we're not talking about that right now. So the big ones I'm going to talk about, the ending of the enhanced premium tax credits. So they were introduced during COVID. It was supposed to be only 2 years, and then it got extended to the December 31st of 2025. Those are ending. There is rumors out there from people that I know, hopefully not agents, but clients that are thinking tax credit is disappearing altogether. That is not true. It's the enhanced part of it. So the expanded eligibility is probably the biggest expansion, the enhanced part. So expanded eligibility, when the Affordable Care Act was first created, was anybody between 100 and 400% of the federal poverty level got a tax credit. And they came up with an algorithm and said it should take the second cheapest silver plan, and we're going to add as much tax credit as we need to make it cost 10%. 400 was the limit. Anybody over 400 doesn't get any. The first few years, it wasn't even a deal. I never even looked at it because the rates were affordable. There were some things that happened, an executive order in 2017 that blew this all out of the water. And suddenly I had to look at, there's a cliff because the rates were so expensive. Well, during COVID, because of all the stuff that was happening, they said, you know what? We're going to get rid of this cliff. So 100 to however much, if the rate is going to cost you more than 8.5% of your income, we will give you a tax credit. That was the expansion of the eligibility. So anybody could be eligible to get it if they were above 400. If it cost more than 400% of the federal poverty level, you get a tax credit. That's ending. It's going back. This is coming back up. Only eligible between 100 and 400% of the federal poverty level. And yes, I know there are expanded states where it's a little bit, there's 150 or whatever, but that's that bracket. Under 100 in the states that are not on their own exchange is supposed to be Medicaid. Now, my state has an amazing Medicaid system. Minnesota, great Medicaid system. We know 2 states right now that don't have one, and there was a lot of fraud in those states. But that was the theory. I do think when they made this, they honestly thought all the states were going to jump aboard and bring it on. And they just didn't for all kinds of reasons. So the eligibility is changing. The lower caps on the premium contributions. So that's ending. It's supposed to cost roughly 10% of your income. And again, for whatever reasons, during COVID, they said, well, that seems like too much. We're going to make it 8.5% of your income. So we paid, overall, the tax credits went up 1.5% more. Well, again, it's just reverting back to 10%. Personally, I've been saying 10% because that's a whole lot easier math than saying 8.5. I can say somebody, hey, if you make $10,000, 10%, so it's reverting back to 10% of income. So again, that's pretty affordable. And if they're in a bronze plan, it's typically less than 10%. So it's, and again, every county's slightly different. Every state has their things. We have a county right next to me. Their gold plans are cheaper than their silver plans, but everyone's a little different. It's going to go up an extra 1.5. And then they had some forced $0 premiums for low income. And I have been working with low income since 2013 when we started this. And low income, if they could get the CSR for 13 cents or $4, they were happy to have it because they understand they have no income. They're too high to be on Medicaid. They wanted that stuff. So even though there is still going to be people that will pay nothing for their insurance, if somebody makes $30,000 and qualifies for a CSR, but they don't want it, they can get a bronze plan for nothing. So don't think everybody's going to have to pay something. There's just no more of these forced $0 premium plans. So there will be people that will pay nothing. All right. The other one is the potential increase for the max out of pocket. This one actually pisses me off, probably with the most. So Centers for Medicaid and Medicare Services, or Medicare and Medicaid Services, has approved a higher max out of pocket for 2026. So they tell the insurance companies what they are allowed to do. It doesn't mean the insurance companies have to, but they are now allowed to increase the max out of pocket next year to $10,600 for an individual. That's $1,400 increase in 1 year. Never seen it. Last year it was $9,400, and then it actually came down $200, which is the first time I'd ever seen it come down. And it was like, woohoo! And $1,400 increase. A family of 2 could potentially be out $21,200. Can you imagine this? You have a family of 4, mom, dad, 2 kids, and they're making $70,000. And they could lose $21,200. That's insane.
That's not even including the premiums to have the plan.
Correct. This is just if they use it. So remember when I talk about, if you've ever seen any of my classes, layer, layer, layer. You have to protect people from medical debt. The premium is not what's going to put them in medical debt. This is going to. Offer the accident, offer critical illness, offer indemnities, and you'll see what I do at the end, but you have to. You have to protect them from $10,600 or $21,200. It's stupid. Now, just so you know, by the way, they're allowed to. They don't have to. We have one carrier. Yay, we've seen their plans. It's one of our favorite carriers, and their number one plan, they kept it at $9,200. But is United Healthcare going to keep it at $9,200? I don't know. Is Anthem? I don't know. But I'm telling my clients now, start thinking about how you're going to handle this. Be prepared for 10,600. All right. So you might be saying, why am I here? This sucks. So I'm going to show you. So this is what I did for my people who were bordering the cliff. We sent out a notice to them about this class based on their income. And we said, this is where we have you. If you're in this category of income, an HSA is going to be the thing that will get them affordable premiums. I only have the top two on here, but federal poverty level, 62,600 for a single, 84,600 for a couple. And some of you might have went, wait, what? On this page, you have 67 for a single. You have 93. That's over the cliff. How are we going to get them money? HSAs. Because the income matters more now than the past. You have to tell your clients. This is the federal poverty chart. You cannot go over. Cannot go over, not even by $1. And if you think you're going to go over, you need to contact me. It happens. We've had people contact me in the middle of those years when this cliff was a huge deal. One of them called me, get my kid off the plan right now. Their kid graduated from college, got a 6-figure income job as an engineer. They needed his income off of it right now. Things can happen. My goal is that not one of my clients is going to be surprised by this. Make that your goal. Nobody who works with you should be going, what? There was a cliff? What? I didn't know. Even the ones who aren't paying attention. It won't be because I didn't email them, phone blast them, and text blast them. All right. HSAs are the solution to affordable premiums if you're in those category in that bracket of income. What is an HSA account? It's a health savings account. It's tax-free savings that can be used to pay for medical expenses not covered by, traditionally, high deductible health plan. There's 3 benefits. It's a very nice tax benefit. Contributions are pre-taxed, earning money. So any interest that's earned, if you do invest it, you get that money for free. It's all tax-free. And then you can pay for qualified expenses with tax-free money. And there's a lot of qualified expenses. If you want just a snippet, look at hsastore.com. Thousands of things. There's lots of stuff. There's some really cool things that you can use your HSA for. You can also just let it sit there and raise money. So dig into what HSAs are. But the reason I'm telling my clients about this, and the reason you need to tell your clients, is this. All contributions can be made pre-tax. Now, this is the HSA contribution limits that have been announced. If you're over 55, you can put 5,400. If you're, or as a family, 8,750. If there's a family of 2, one person's on Medicare though, you cannot put 8,750 or 9,000. You can only contribute the amount of how many people are in the plan, that are enrolled in the plan. So if you have we have a lot of early retirees and one person's on Medicare and one person's on the marketplace. Well, they can only do 5,400. But that 5,400 is a family. Anybody in the family can use it. So what do I mean when I say pre-tax deduction? So I did this with a fixed person who's got a fixed income. They're not self-employed. They're not working. They can't contribute to an IRA. They got a pension, Social Security, 25,000 annuity. Their grand total, 64,000. They're over the income limit by 1,400. And this is their fixed amount. This is how much they need. So when I say pre-tax, that same 64,000, if they contribute, they go to the HSA, contribute 2,000, they're now, well, I got an extra zero in there. They're now at 62,000. They qualify. They're under the income limit. HSAs come off of the adjusted gross income. The income is now under the threshold. So they qualify. They get the tax credits. So real life example, you're a 62-year-old, your income for 26 is 66,000. You're over the cliff by 3,400. Without an HSA, the premium for my number one plan, $1,064 a month. They'd have to pay that times 12, but they're only over by 3,400. But if they go put 3,500 in that HSA, that same plan will cost them $315.
Hey, Kristina, are you sharing your screen? Because I only see you.
Yep.
Okay.
There is some new Zoom things. You might have to look. I don't know where it is, but there is a spot where you can see the shared screen sometimes. If you're a family of two, because again, I have a lot of early retirees. They're making 92. They're over by 7,400. It's going to cost them $2,329 a month. But if they can find a way to put 74, or I just say always over 75 into that HSA, that same plan will cost them $365. I would rather they paid themselves than the insurance company. They would rather pay themselves than the insurance company. These are not people that have $200,000-$300,000 and are like, I can pay $2,000 a month. These are the people on that edge. HSA advantages, disadvantages. This is a little outdated just because of the whole HSA high deductible plan, but pros, it's pre-tax. It lowers their taxable income. When they use it correctly, it's tax-free. It's one of the only tax-free for life that there is. Usually a lower premium, greater flexibility on how that money is spent. If somebody wants to go to alternative doctors, they can use HSA money for that. They just approved the primary care doctor model, which is awesome. We don't have much of those in my little neck of the woods yet, but where you pay $1,000 a year to have a doctor, and that's your primary doctor. You see them all the time. They don't run it through insurance. Kind of think like a chiropractor that's just cash. You can use that money for that. There are so many things that you can spend your money on. Prescriptions, co-pays, glasses, if your insurance doesn't cover, dental work. There's a lot of things they can spend their money on. And the money is theirs. It's at their bank. It's their money. And it rolls over year after year. They can keep stacking. Anyone in the household, taxable household, can use it for medical expenses. Lots of options. Some of the disadvantages is it can have a higher max out of pocket. But now with the new, hey, if it's a bronze plan, maybe not. There is a 20% early withdrawal penalty for non-medical expenses. So if they get audited by the IRS and found out that guy just went and bought a TV, yeah, they're going to have a penalty. They're going to pay interest, and they'll probably pay some fees. So there is you have to leave it there. And sometimes prescriptions can cost a little bit more at the beginning in a traditional high deductible plan. But again, bronze plans, doesn't matter what kind, are eligible for HSA. And the biggest one is people need to be able to contribute that money there and leave it there. So if they are really like their living expenses is $66,000, it's like you have to be able to put some money into that HSA. Now, the government does not care when you put the money in a calendar. They cannot open an HSA account this year to do for next year. They got to wait. January, our clients can go to their bank. I'd like to open an HSA. And they put in just enough to keep it open, whatever the bank wants, $20, $50. And it just sits there. And then December 31st, they kind of look at their taxes and they go, oh, I'm going to owe back, I went 2,000 over. They can put that 2,000 in December 31st. They can put the entire amount in January 2nd. They can do each week. I have one lady who has an account, and what she puts into it is when she gets a bill. Whatever her bill is, she puts that money into the HSA and then pays it. And then at tax time, whatever her medical bills were that year, that's her tax deduction. So there's lots of ways to do this. They will have affordable premiums, though. That's the biggest thing. That's why I want people to understand how this works. It's going to be affordable. All right. How do you get an HSA? Well, the big beautiful bill said you have to be in a bronze or catastrophic plan on the marketplace. So this does not apply to employee benefits, and it's not any plan. So they would have to do it through the marketplace effective 2026. or they can pick a qualified high deductible silver or gold plan, the traditional HSA type of plan. So here is, no, I picked a traditional HSA, which is the right column, and just a high deductible bronze plan. That's not a qualified high deductible bronze plan. You can see the deductibles are different. The max out of pocket is lower on an HSA than it is on a just bronze plan. But if you look at everything else, primary care, specialists, generics, all that is always after deductible. So in the past and this year, a qualified high deductible health plan, you are paying, you have to have money out of your pocket before the insurance kicks in. Well, Congress said bronze plans, and that means somebody can be in a traditional bronze plan with a high deductible with copays and go put money in the HSA. I'm very excited by this. I don't know about you, but our number one bronze plan is a $0 deductible plan. That is what everybody's going to be in. And then they get to go put money in the HSA. The IRS may catch up on that eventually, but so far they have not. So, and somehow I scribbled on my screen. We have in some counties, there's silver and gold HSA plans. You can look at those. Sometimes they make sense. Sometimes they don't. Sometimes I'm going to pay $5,000 more in premiums to save myself $4,000 out of pocket. Like that may not make sense, but sometimes it does. We're going to go back. Nope, can't figure it out. Oh, I don't know if you can see that scribble. I don't know what it is. Anyways, here is a reminder about what the income they're looking for. They need the modified adjusted gross income, the MAGI.
Well, let me touch on one thing, Kristina.
Sure.
What if someone is considering the HSA route, but they are instead looking at other plans, not bronze?
Then you have to be in an HSA. That's why I showed the qualified silver or gold.
So then it doesn't fall under that special exception where bronze plans could be HSA eligible even if they don't meet the typical rules. If you're selling a gold plan and trying to pair it with an HSA, like you're gonna have to follow the rules correctly.
Correct. Yep. You have to follow rules. If it's a bronze or if it's a gold or silver plan and they want to contribute to an HSA, they have to be enrolled in a HSA qualified high deductible health plan. So don't just think anything works. It's only bronze plans. You have to be in a bronze plan on the marketplace for this to work.
So if you're going off the marketplace, still you got to follow the general rules. And do you know what that high deductible requirement is?
Then it has to be a high deductible qualified health plan.
I think this last year it was like 1,600
I believe
minimum
next
deductible.
year it's 17.
1,700
is the max deductible. Yep.
minimum deductible.
Or I mean the minimum deductible, not max. Minimum deductible for high is a 1,700. I do believe that might be kind of the workaround for our $0 deductible plans is that they have drug deductibles and they typically are more than 1,700. So, yeah, you have to stay in this HSA if you're in the gold and silver, you or off exchange or on an employee benefit. You can't just go, hey, I'm going to get you a bronze plan and it'll be fine. It's not. It's only for very specific marketplace bronze plan. And again, IRS doesn't seem to be, it's funny, the insurance companies are waiting to see if CMS is going to do something about the $0. And CMS is, I talked to him in Louisiana a couple of weeks ago and he was like, what? Like completely clueless. He didn't even know this was an issue. And he's like, let me send me an email. I will email the IRS guy. And I went, no, I'm good. I'm good. I don't need the IRS to pay attention to this yet. They may come out in 2027 for 2027 saying you have to have a deductible.
Give us a year, yeah.
So it could happen, but I don't want it to happen for this year. So the plans are already out there. I don't think they could even if they wanted to. All right, adjusted gross. They're basic. If you have to tell the IRS about your income, you have to count that. Other income is what kind of screws people up because they'll be like, oh, my Social Security isn't taxed. Well, the government knows you're making that. You have to do the gross amount. You're allowed to do certain deductions, and this isn't a fully comprehensive plan, but this is, talk to the accountants. But if you are fully retired, HSA is kind of it. I know there's a gambling one you could maybe do, but your student loan interest, not student loan payment, your student loan interest is probably not going to be enough to put you under the cliff. So I don't even talk to people about that. It's HSA contributions. So,
Chris,
yes,
just a clarifying question. So the whole reason they're doing this is to reduce their income so they don't go over the cliff and have to pay back their full subsidy. Is that correct?
correct.
So if they decide not to drop this, then this is going to be basically irrelevant. Is that right?
What do you
Or
mean?
Is this law now? Is this definitely happening?
HSA is law.
Okay.
That's law. That was in the big, beautiful bill.
Okay.
So
Thank
Annie
you.
Bronze right now qualifies for HSA. The tax credits are based on household income, both spouses. And if they have a dependent who's making more than 12,000, it's based on a sliding scale up to the 400% of the federal poverty level. After 400, there's no sliding scale. It's based on the second cheapest silver plan in your area based on age, family size, and zip code.
Kristina, when determining taxable income, this is
Yes.
Martin from Austin. Do you advise people to not consider their, what's the, I guess the standard deductions until tax time?
No, you cannot count that.
Okay.
The standard
Tax-
deductions happen after the adjusted gross income.
Okay.
Now, if somebody's self-employed, I got a lot of farmers in my area. I still remember a couple sitting here in 2018, and I'm like, under no circumstances can you go over $64,260, because if you do, you're going to pay all this back. And they were farmers, and he starts grinning, and I'm like, that's a really weird response. His wife going, "Oh, we're going to buy a new tractor, aren't we?" So if you have self-employment, you can use some of that. But if you're not self-employed, you can't. So, yep, this is what they're calculating it on. The adjusted gross is the max. All the other deductions come after that. The standard deduction, nonprofit, all that, it's not going to help. They have to do it from that adjusted gross. All right. If you make less, you will still get money back at tax time. Now, honestly, if you're paying nothing, you're not gonna. But example, you report $64,000 on the application. They qualify for $2,000 of monthly tax credit. The actual income turns out to be 54. All right. They're going to go, the IRS is going to go, okay, you didn't get enough. They're going to get back $984 of unused tax credit. People misunderstand that too. If you overestimate your income and you come in under, you could get money back. But again, if you're paying zero, you're not going to get, you're not making money. You have to have been contributing something. So it's possible. But of course, this is the big reason we do this. The reverse is also true. Your income and the tax credits paid on your behalf must be reconciled, right? You tell your client you have to do this. I don't know why anybody wasn't reconciling their taxes and that whole federal law thing that's happening. I'm like, no, people have to reconcile their taxes. Otherwise, I would just say everybody makes 20,000 or something. But if the actual income on the application is more than put on that application, they could pay it all back. And you're going to get some really angry people if they don't know this. And accountants are horrible. They don't know how the marketplace works. They don't know that the person only went over by $100. They just go, yeah, that insurance sucks. They're a little bit better now, but there's accountants that are just like you. They didn't start doing this till COVID or after COVID. So they're not familiar with this. Their actual income's 85. They're only over by $400. Yeah. They have to pay it all back because they did not qualify. Right now, for 2025, when they file their taxes, in this situation, they may have to pay $40 back. 26, all of it. It's not prorated. But don't tell people it's a penalty. It's not a penalty. They just didn't qualify for it. It wasn't theirs to have. There's no interest. There's no fees. They're not penalizing you. The IRS isn't going to let you, oh, well, you can't sign up next year. You just didn't qualify. So you have to pay it all back.
Chris,
So-
can I ask a quick question on that? Sorry. So if they didn't qualify for that level, but
They didn't qualify, period.
period. So they're gonna have to pay the full thing back if they're
Right.
over by, okay. I just wanted to understand that. That's crazy.
Yep. If you make $1 more than the 400%, you did not qualify for it.
But
I had a client pre-COVID, where the subsidy cliff was still in place, who they were fine all year round, all year, because we had closely, like, where's your income? How's it going? He got an end of the year Christmas bonus that he could not have predicted. And that pushed him over the edge where he ended up owing like $23,000 back. He had a zero premium plan, otherwise. And just the county he was in, it was really weird. Like, the tax credits were crazy. He had a family of 5, so that helped. But
Yep.
he had
It's
to pay
not prorated.
himself, but he
Not prorated
contributed.
anymore.
He
Yep.
contributed in his situation into an IRA, not an HSA. That's an additional strategy.
Which we'll talk about.
But in paying himself, at least he was able to avoid paying the IRS.
So it sucks. This cliff thing is a pain in the butt. But again, that's why I'm showing you this.
Hey,
That's why I'm
Chris.
telling my clients.
Quick
And I
question.
tell them, if you are suspicious, if you're worried, call me any time in the middle of the year. So I'm telling them
Chris.
to look at the clip. Yes.
Sorry, this is Donna. Okay, and earlier on the qualifying income, you said the Mr. or the Mrs. and any dependents making more than 12,000 a year.
Or 13.
Pardon?
Or 13. It goes up a little bit each year.
Okay, so but that is a dependent. So if the person is, if the child, adult child, whatever, is living with them, making 25,000 a year, but filing their own taxes, they don't
And
have to.
that's not a dependent.
Okay, good. All right, that's what I wanted to clarify.
That's
All
not
right,
a
good.
dependent.
Yeah.
They're their dependent as far as biological. But when I talk about families and
Right.
dependents, I'm talking about IRS taxes.
Hey,
Got
Chris,
it.
I have
Okay.
a quick question too.
We've only got 15 minutes left, so I haven't finished. So
All
yes, go.
I have a client say they have a dependent. Mid-year, the dependent gets a job and pushes them over that cliff. Does it matter at that point because they got the job mid-year? Before
Yep.
that, they didn't have a job.
Doesn't matter. IRS does not care. Kick them off the plan right then. And then their accountant can separate it when the filing and reconciling. So
But would they
don't take
be
the parents over
responsible
the
still?
cliff. What?
Would they still be responsible for the full amount if they're over the cliff?
Yes,
With
if
it-
they keep that kid on the plan. Take that kid off, and then at tax time, their accountant files it separately.
Okay.
I don't
Thank
know
you.
how. Don't ask me how. I know because it happened. It can be done. All right, I'm gonna move on. I'm telling people, look at their income. Remember, this is if they're straddling. If they're under it, if they're like, no, I'm below that FPL, tell them they don't even need an appointment with you. They're fine. The rate is going to be affordable. I'm sending a letter. You can say, I'm going to send you a text. I'm going to send you a link to update, whatever it is you're telling them. But if they're under the 400 of federal poverty level, they're fine. They just need to know you got them and they're good. If they are right on that edge, right? If my client's like, well, I'm right near it, put them in a bronze plan. And we're meeting with them in November, December, if they need to. Everybody who's in a bronze plan on January should go open an HSA account. Because why not? You can contribute to your HSA all the way up until April 15th of the next year. So they could just go, well, just in case. They opened their HSA in 26. They put in, $50, whatever. They do their taxes in February. They find out they're over $1,000. They go to the bank. They say, all right, I'm going to contribute $1,000 for 2026. They just put their income under and they're fine. There is no reason not to open an HSA this year. If you're in a bronze plan, just do it. When you go to the doctor and they're like, you have to give us $70, pay it with the HSA. Every time they buy prescriptions, go to the doctor, co-pays, anything, it should just be going into the HSA. Why not? Who likes to pay more taxes? Everybody likes to pay less. We are also telling them, see their financial advisor. Maybe they have solutions. And they need to be prepared to contribute money. They have to have that money. Again, the IRS does not care where you get that money from, unless you're doing it illegally. But I sell accident policies all the time, indemnity policies all the time. That money they get from the accident policy to pay for the accident, they can use that money to put in the HSA. They just can't go over the allowed amount. If they're way over, I'm telling my clients, oh crap. Talk to your financial advisors. Maybe they've got solutions. And if they're relatively healthy, I have some affordable options. And if they're married and one person's sick, they don't have to both be in the same plan. There is zero reason for somebody to be in the same plan if one's healthy and one never goes to the doctor.
Okay.
Right? I mean, why pay $1,000 for the healthy person? Put the $1,000 on the unhealthy and put the healthy person into something else. And then we're telling them, if they know they're over the cliff, see us in October. I can get you signed up for January and I'm done. Now, you don't have to do that. We have a stupid amount of clients to get through. If their income's going to be higher, we've got some options, right? This is what you guys are all talking about. This is very brief, so don't get into too many details. It'll be a different webinar. But if they're healthy, I've got short-term plans, indemnity plans, underwritten plans. There are 2 share plans that I personally feel comfortable sharing and putting people in. If they're not healthy, they're going to have to pay full price. And if they're kind of unhealthy, there are some simple underwritten plans they may be able to get into.
Whoa, what's going on?
All right, short-term plans. What are those? In my state, I can only have it for 364 days. There's limitations. They don't cover pre-existing. They may have limited benefits. Like, I don't know if you know this, they don't cover hernias. I don't know if any of them do. Why? Because you can live with a hernia for 12 years. They don't cover hernias. And it's limited. Even if you're in a state that has it for 3 years, there's a limitation. Indemnity plans. What are those? They pay a dollar amount to you. I do not go into my doctor and go, here's my indemnity plan. There's no contracts. I tell them I'm cash pay. This is how it works in my state. Some states, the network works, but my state, Aurora, sucks. They are not going to work this way. So I'm a cash pay. The indemnity pays you the amount. There's no limit. That's or duration. So that part, somebody could take that one. An underwritten plan. You're healthy. You pass it. It's a full major medical plan. It is just like what you have. And once you're in it, you're in it. And they can keep it until they turn 65. But you have to be healthy, relatively speaking. You can't be an insulin diabetic. I can tell you right now, insulin diabetics have to be on the marketplace.
Chris, who has the full underwritten plans?
USA Health.
That's the only one?
It's the only one I know of.
Okay.
I know there's a couple others out there, but that's the one I'm the most familiar with.
Okay, thanks.
There are share plans. So what is a share plan? It's not health insurance. They don't have deductibles. They have member responsibilities. Typically, it's a cash pay. Once again, I'm cash pay, and you submit the claim to the share plan. There's one that I like that's on a phone. All right, it's just different. I talked about that last year. You can go look it up. It's called Redirect. It's a little bit different. People have to understand how it works. But if you talk to the doctor on the phone, your bill's like this much. So there are some out there that kind of work, but they need to understand it's not going to be like it normally is. This is the stuff I offer all the time. Accident policies, GAP, critical illness protection, hospital stay, final expense, short-term, long-term. Critical illness, listen for when you offer it and somebody goes, oh, I have money in my IRA. Okay, your max out of pocket's $10,600. You get sick with cancer and you pull out $10,000 out of your IRA. What just happened? You just put yourself over the cliff.
Plus a
So
30%
now you're
tax.
paying the full max out of pocket and you're paying the full premium. I'd rather you pay $40 for a $20,000 critical illness policy. Let somebody else pay for it. Last little bit, These are the things to talk to their financial advisors about. I've just been doing this a long time. If they are still working, they can contribute to their IRA. Awesome. Let's figure that out. I had somebody work part-time and that's what they did. Her entire paycheck went into the IRA and they got to put a little extra in. If they take money out now, tax ramifications aside, I have no idea what that means. But if they take out $20,000 this year, they're probably going to have to pay about $2,000 back for their for the overpayment of their insurance this year. But next year, they're going to have $20,000 sitting in their savings account and lower their income by $20,000, and now they qualify. But again, they need to talk to their financial advisor. What else have you got? I know that was a lot. Does that kind of make sense? Yes, Ryan.
I just have a quick question. So if they make way more income than they thought that they were going to make for some reason, like Brandon had mentioned, like a bonus or something, and it pushes them over, but it's more than the amount that they can deduct, and they're in big trouble.
Correct.
Okay.
Which is why you need to tell them. So there are two things that now there's three. There's three things to tell your clients to be aware of that could do that, and then let them decide. One is they have really good stocks, really good investments, and they get their interest rate payments at the end of the year. I really wish it would tell them what it's going to be December and they get it paid in January, but it doesn't. It shows up the last week in December, and that can kick people over.
Okay.
And so I'm like, do you think it's going to be enough to kick you over? If it is, you tell me if it's worth risking it, right? Go talk to your financial advisor. Maybe they should sell half of those. I don't know. I don't know what that means, but they need to talk to their financial advisor. Or, well, the best one we ever got was 10,000. Well, there's two of you. You're both over 55. There's a way to do HSA. That's where we do a little bit of math. Like we kind of wear a mini accountant hat and a little financial, but push them back. I will tell you, accountants are not necessarily the best person to ask right now because this is 2026 rules, and we don't even know what that means yet. They don't have those. We just made rules now that they're still working for 25. So that's why if somebody's going to risk it, go open an HSA. You're in a bronze plan, just do it. The other one, so that's the interest. Another one is annuity inheritances, or they get a little mini IRA or something. So somebody gets this, I don't know, $10,000 IRA, maybe it's 20,000 annuity, something. There are monthly payments they have to take. And somebody's like, oh, it's only 20. Just cash it out. You can put the new roof on. You can, do that new kitchen that you wanted to do. And they just put themselves over by $10,000. And now they have to pay $24,000 back in tax credit. They should not cash those little mini things out. Unless the monthly's kicking them over anyways, and they're just going to cash it out and go on an alternative plan, or, they're going to cash it out to hold the money on to pay, So tell your people to call you mid-year in case there's any of those things. And the other one I have seen, God bless those financial advisors. They tell people, what's going to work really good for you in the future? A Roth IRA. Let's take $10,000 out of your IRA and put it into a Roth IRA. That's income. And it's not even income they get to hold. It's now in a Roth IRA and they can't touch it. And they just got 10,000 into their Roth and they just went over by 5,000. There's not enough to put them in. And now they have to pay back $12,000. So I just warn people. I go, now I'm not a financial advisor, though I do talk to them. This is your chance, man. Write yourself a letter of an introduction and send it out. Mail out a letter to every financial advisor within a 50-mile radius of you. The income cliff is back. Here's the dollar amount. Here's HSA contributions. Please, I'm happy to brainstorm with you. We get so many referrals from those financial advisors. So this is your opportunity. You want to grow your local? Because I don't need to sell in Florida. I'll let, the weirdos that live there in that hot, steamy weather. Right, Jill? Somebody asked, where was it? I was going to say, what do you mean take money out 25 for 26? I'm talking about money out of your IRA, your retirement account, your 401k. If you want to not put it into an HSA, you're just taking money out to pay for your living expenses for next year. And it's now going to sit in the savings account. I've had to do that when people come in, and this will be next year when I do the training, probably in February after my brain resets. I'm going to talk about when people are coming in talking about retiring. That's when you really have to put a little bit of a financial and a bit of an account, because they're already retiring. Like, wait, maybe you should not retire in June because you're going to be over the income cliff by $5,000. But if you retire in July and you hold off your Social Security, so I'm just talking about take a lump sum now to put in your savings account to pay for your medical, for your expenses, whatever that is. Could be the medical. Maybe you've got somebody who's on Ozempic. They're going to pay $10,600, or the medication for rheumatoid arthritis. So they could take the money out. They will pay the difference of, they overestimated their income, but that's a sliding scale. It seems to be for every 10,000 that you take out, you have to pay back about 1,000. But next year, if they take out 10,000 and they're over the cliff, they're paying it all back. So that's what I mean when I say take it out. Thank you again. I appreciate everybody who's logged on, and we will talk to you